Hello, everyone, and welcome to the Small Cap Insights podcast powered by Darrow Associates, which is a leading full service investor relations firm that's primarily focused on micro and small cap equities. My name is Alex O'Toole, and today I am joined by Norm Siegal, the managing director of sales at Northcoast Research. Norm, thank you for joining me.
You're welcome. Thank you for having me.
Absolutely, my pleasure. So, for starters, tell me a little bit about Northcoast Research and what sets you guys apart.
Oh, it's great. A lot of us came from bigger firms. And at bigger firms, we weren't able to control the quality of the research and really develop the product and develop the institutional business the way that we really wanted to. So I came from KeyBank Capital Markets. I was there for 14 years, heading up the Cleveland sales effort. My partners were at a firm called FTN Equity Capital Markets. They were senior people at those firms. And back in 2009, we decided to start our own firm right in the middle of the great financial crisis, which we did. And it's interesting, the timing was perfect because the markets took off from there. And we've been fortunate to have kind of a tailwind from a market perspective. But it's interesting, and we'll get into this in a minute. The business fundamentally changed in kind of the mid-teens, and it became a very different economic environment for the institutional equity business. And so at the end of the day, we saw that a lot of smaller cap and mid cap names were seeing less and less Wall Street coverage. But on the flip side, a lot of institutions still needed small to mid cap coverage, high quality small to mid cap coverage. And so while our core business still remains the institutional equity business, probably 10 to 15% of our business now is corporate sponsored research or issuer sponsored research. And we've been getting more and more traction. What differentiates the firm, whether it's corporate sponsored research or um, traditional research, is our pretty deep and comprehensive channel check work. So we talk to competitors, we talk to suppliers, we talk to trade associations, talk to former executives, talk to suppliers. So we try to build the case for our recommendations around critical inflection points for the companies and the industries that we cover. And we've been historically very successful. So we've been able to navigate a really difficult environment. Again, whether it's a CSR covered company or a traditionally covered company, extremely well. And a couple of years ago, we decided to engage in the CSR business and develop a CSR business, which again, we think our offering is differentiated. And we'll talk a little bit about that too as we go. But that would be, in a nutshell, kind of our firm and really what differentiates us.
All right, so that gives us a lot to work with. Kind of funny and ironic timing that it happened right as the financial world was, doing not so well, and you guys were like, "Well, we're gonna get this started," and that tailwind was kind of what propelled you guys forward in order to be able to be so successful in, where you saw those gaps kind of in the market and where you saw that you guys could be most valuable. Is very interesting. I think it's very interesting and timing the way that the universe kind of times things out sometimes is always very interesting to me.
Yeah, exactly. And at the end of the day, what our clients are looking for is really high quality research, unbiased, high quality research. And that's what we've been able to provide. And so we've outpunched a lot of firms our size by virtue of the quality of the work that we do and the differentiated way we do it.
So, can you tell me a little bit about that actual research that you guys use to project those business trends and the future growth using those different unique sources of the real-time information coming in? What is the approach that kind of goes into that to the extent that you're able to share?
Sure. Well, we've got senior analysts and we've got associate analysts, and the associate analysts support the senior analysts. And every analyst will do a different type of channel check work. So in the fintech space, channel check work looks a little bit different than it does in the auto parts retail space. But the idea is that we do regular surveys, we do screen scrapes, we do interviews, and as I indicated, we also talk to a lot of industry contacts unaffiliated with the companies that we cover. So we're not just speaking to the management teams, we're kind of building the ecosystem out, beyond management so that we could take a critical view of what the company's guiding to and what the company's saying publicly. And so that's kind of what we do. It's interesting. For each one of our analysts, we've got a bio. And on the second page of the bio, we highlight all the different channel check work that each one of our analysts does. And we kind of highlight why what we do is important. So, in other words, we're channel checking not on something that doesn't move the needle for the company. So, we're not going to spend a lot of time channel checking on 5% of the revenue mix. We'll understand the key drivers for the industry or for the companies that we cover. And that's where we'll do our channel check work.
So you guys are kind of unique in the way that you kind of get it on all levels, like from each different industry, and then you get it on all different levels, and you have people that kind of specialize in those to really be able to maximize the research and the value that you're able to kind of provide for your clients.
Correct. And I think what another thing that differentiates us is that we don't do any investment banking. So we're what's called an independent research provider, which means that we live and die based on the quality and the integrity of our research work. So our research is unbiased um, in the way that it could otherwise be if we were involved in other lines of business, like, for example, corporate finance. And so I think we've got a truly independent view of our companies. I think our clients really appreciate that. And I think in the CSR, the corporate sponsored research realm, the benefit to the companies that we work with is that they could choose who they want to work with on the research front separately from who they want to work with on the corporate finance front, for example. And it allows them the flexibility to optimize those decisions and choose exactly who they want to work with, depending on the specialty they're looking for.
So I have a few questions out of that, but firstly, is that corporate sponsored research that you touched on becoming more mainstream?
Yes, it definitely is. It definitely is. And so, we can move kind of into the meat of the order. But when you talk to companies, boards are increasingly approving it as part of a standard visibility strategy. Um, Small to micro cap companies now routinely budget for corporate sponsored research. Um, Institutional investor conferences now regularly feature corporate sponsored research coverage companies. And you'll find this interesting because I think your constituency is um, probably small to mid cap oriented. And so NERI, which is the National Investor Relations Institute, last year issued a policy statement on issuer paid equity research, including guidelines to its membership. And I could forward that to anybody who'd be interested. But the guidelines highlight the importance of equity research coverage to public companies, recommend CSR as a viable option for companies interested in elevating their profile, offer suggestions on what to look for in a provider, and then advise CSR providers, so companies like us, on how we should structure our offering from NERI's perspective. So NERI is kind of the best example of how it's become more mainstream. But the other thing I'd point to um, is that I don't know if you're familiar with MiFID, but MiFID was a series of regulations or a body of regulations instituted in both Europe and the UK back in 2018 that really governed and regulated how investment management firms used the commission dollars of their investor clients. And the idea was that um, they had to be held accountable um, for how they deployed those commission dollars. In other words, they weren't owned by the manager, for example. They were still owned by the investor. And so it changed the idea around um, um, how management teams paid for research. And at the end of the day, there were a lot of unintended consequences. And so you saw dramatically lower research budgets in Europe that sort of spilled over into the US for a variety of reasons. But the UK and the EU um, used, they were separate regulations, and the UK led the charge in what the ultimate regulations look like. But there was a firm called Hovell Lovis, which did the original work for the UK Chancellor of the Exchequer on the original implementation back in 2018. And then a few years later, 23 and 24, did a lot of work recommending the unbundling or the unwinding a lot of the provisions that led to much less coverage for small to mid cap names. And one of the recommendations, and again, I could send this to any of your listeners who would have interest, was the creation of a national small mid cap research platform to help generate research for small and mid cap companies, and specifically supported the idea of issuer sponsored research to close the coverage gap versus larger cap companies. Um, and in that same document, they asked the question, is the amount, the quality, and the type of investment research sufficient to meet demands for small and mid-cap public company investors? And the specific quote is, sponsored research, which is paid for by the issuer, is generally seen as performing an important role in providing coverage of smaller cap companies, and there is general agreement that more should be done to encourage the production of more high quality issuer sponsored research. So to answer your question about whether or not it's becoming more mainstream, that's kind of how I would answer it from the public good standpoint. But then when it comes down to working with our clients, it's a similar type discussion. And it gets to kind of my original response to your original question, um, which was kind of how do we get into this and et cetera. 10 years ago, it was viewed as a conflicted product. In other words, how can you do work with integrity and have an independent view when you're getting paid by the companies that you cover? And so when I'm sitting down with T. Rowe Price, when I'm sitting down with Fidelity, when I'm sitting down with Capital Research, my discussion is, really the following. Um, your budgets are down, and we haven't covered this, but the fact is institutional budgets for research are down between 50 and 60% over the past 5 to 10 years. And it's down even more so for small to mid cap names for another set of reasons. But when I sit down with them, I say, hey, you can't have it both ways. You can't take your budgets down for small to mid cap research by 50 to 75% and expect the economics of the business to stay the same, such that we're going to continue to cover those names. Um, it just can't work. And so we figured out a way uh, to continue to do really high quality work on names that you definitely care about, but no longer have the ability to pay for in a way that makes it economically viable for us. Um, Number one. Number two, we're an independent research provider, which gets to kind of a partial, what I was sort of talking about a little bit earlier. We're an independent research provider. We don't have any other business lines. And so at the end of the day, we're being held accountable and we're willing to be held accountable for the quality and the integrity of our work across our research platform. Like I said, only about 10 to 15% of our current coverage is CSR. The rest is core. And so measure us against the highest standards, and we're happy to be held to that level. And so it resonates. We don't market under a separate brand name. We don't sort of do less high quality work. We have senior analysts who cover the space, who have industry experience. We're trying to be strategic with the companies that we partner with on the CSR front so that they get the benefit of our industry expertise and they get the benefit of our specific channel check work as well. And in that way, if you're doing it the proper way on the CSR front, it will absolutely resonate with institutions. And at the end of the day, they're not going to care. They're going to look for the quality of the research and hold us accountable as they would with any other covered company.
So you kind of answered every question that I would have had as you were kind of going through it, talking about why that research really is important in that space. And it's very interesting how much they reduce kind of the money going in and expect everything to stay the same. It's funny how that just happens to happen across industries, and the funding
Yeah,
goes away and they want the output to go up. And it sounds like you guys have really been able to creatively find a way to just not only continue, but kind of expound upon the value that you're able to provide there. So out of that, and we talked a little bit about, or a lot about, CSR, how does someone go about selecting a CSR provider?
yeah, it's really interesting. It's a little bit like the Wild West out there. And so it's interesting. A lot of companies have to get over the threshold. Hey, do we want to do this? Yes or no? Um, at the end of the day, you know, they've got to make a determination that, yeah, it makes sense. One of the things that we talk about up front is that they should think about it more as an investment as opposed to an expense. Because what's interesting, and we did a lot of work on this, and I could, again, forward some of the material, but we looked at the correlation in terms of share price performance, in terms of valuation, and in terms of average daily liquidity by research cohorts, 0 to 3 covering analysts, 4 to 6 covering analysts, and then 7 to 10 covering analysts over a 5 and 10 year period of time. And there was a high degree of correlation between share price performance, valuation, and share volume liquidity, and number of covering analysts. So thinking about that, it wasn't causal, but it was correlated. And intuitively, it makes sense that if you've got a good story, the more people who hear about it, the better it is for your metrics. The metrics that we chose were specific because a lot of management teams are actually based on the performance of the shares over time. A lot of management teams have outright stock grants, restricted stock, options, etc. And the boards ultimately report back to the shareholder. And then when you think about things like valuation and liquidity, that gets to cost of capital. So if I'm a public company um, and I want to do an issuance, like a secondary, to help fund a capital project or to fund an acquisition, um, the higher the valuation, the lower the number of shares I have to issue, so the lower implied cost of capital. Same for liquidity, because liquidity gets to the discount you'll have to pay to do a secondary offering. So if you've got a highly liquid stock that has a lot of average daily trading volume, it could be a quarter point discount as opposed to a half point discount, or a half point discount as opposed to a full dollar discount. So at the end of the day, the more the liquidity, the higher the valuation, the lower the cost of equity to do either a capital project or an acquisition. And then finally, on that front, when companies are working with banks to issue debt or take down debt, frequently one of the metrics that the bankers use to price the debt is the equity valuation and how the stock has been performing. So that's the first hurdle we have to get them over. Although it's becoming easier and easier. Like I originally had to walk through that math a lot with the CFOs in particular. It was pretty funny. And they all loved that sort of analysis. But at the end of the day, it's becoming, to your prior question, a little bit more mainstream. But at the end of the day, if they've gotten over that hurdle, they still have to make a decision, to your point, about kind of how do I choose the right firm. Some things to think about, and I'm going to go through them pretty quickly. You could certainly follow up with anybody if they'd like to follow up with. But is the firm's coverage primarily traditional or CSR? And why does that matter? It matters because if it's a traditional coverage firm, then they're truly going to have institutional relationships that'll be beneficial for you as a public company. If they're exclusively CSR, there's no way in the world they're going to have the relationships at T. Rowe, the relationships at Fidelity, et cetera, that maybe you're looking for. That's not all you're looking for in terms of investors, but it's an important component to understand whether they have institutional credibility or not. Secondly, is the firm an independent research provider, or does it have multiple business lines, including investment banking? Well, we talked a little bit about that, why you'd um, much better um, kind of work with somebody who lives and dies, based on the quality of their research, because that's going to be their priority, and not have other business lines to rely on. Three, try to assess the quality of the firm's overall research effort, as well as the specific analyst you'll be working with. So you want to understand how the firm does, because you could have a really high quality individual analyst who's part of a firm that doesn't really resonate as a firm at some of these big institutions. So you want to know about the firm in addition to knowing about the individual analyst. Is the firm strategic in who it partners with. You know, I was talking before how we want to align ourselves with corporate sponsored research partners that fit within our industry verticals. Will the coverage be from a senior analyst with deep industry knowledge and real institutional relationships, or a less experienced generalist? So if you look at some of the CSR firms, they won't have senior analysts on coverage, and they might have analysts on coverage. You want to make sure you know the background of who's going to be covering you in addition to the quality of the overall firm. Is the analyst working independently, or does he or she have associate analyst report support? That's critical, and it gets to, again, the quality of their overall work. Does the firm have a separate go-to-market brand for its CSR coverage? Some firms will market CSR under a separate brand. So, for example, we don't, and so that's something that we point out to clients. Does the firm issue ratings for its CSR covered companies? Some do, some don't. Does the firm update financial models at least quarterly for CSR covered companies? Some firms do, some firms don't. Does the firm participate in all investor events? So, in other words, if you're hosting an investor day, will the CSR firm commit to kind of being there? If you're doing a field trip, will the CSR firm commit to being there? All that matters because that is an economic commitment that not a lot of CSR firms can necessarily deliver on, but it's critical to the quality of the coverage. What market does the firm focus on? Is it retail or institutional? Some firms focus on the institutional market, some firms focus on the retail market. Well, you know, both can be important, but you should understand if you're selecting a firm, ask about kind of who their clients are. Does the firm have a well-developed corporate access program? Number of conferences per year, number of non-conference events. Do they do in-person NDRs or is it exclusively virtual? You know, that's an important thing to think about. How does the firm distribute its research? In other words, are you on all the major platforms? And is there open access to investors who are current clients and not current clients? So for our core institutional clients, we, for example, have to entitle them to have access on those third-party platforms like FactSet, Bloomberg, Capital IQ, Visible Alpha, to have access to the published work. CSR clients, that's not the case. There is full access. So anybody, regardless of whether or not they're a client of ours, will have access to our published work on those third-party platforms. Pricing, you know, how does the firm price? And that's going to be a critical thing. But bottom line is, if you're like most companies, you'll likely want to work with a CSR provider targeted on the markets you believe are important, where they'll be covered by senior analysts with relevant industry expertise, and significant and demonstrable credibility with institutional investors in an excellent corporate access program. So that's just a quick little checklist, but you know, I was hoping when we set this up, Alex, that that would be the focus of the discussion, because I think there's a lot of public companies who have seen less and less Wall Street coverage and who are wondering, oh my gosh, I've got two covering analysts, I've got three, and I'm working with all these firms. I'm trying to incent them to kind of pick up coverage. They're not. The reason they're not is because the economics don't make sense under the traditional model. And so at the end of the day, I wanted to I really focus on that. In other words, for these companies who are struggling for coverage, and kind of are interested in talking about it, but then how do they select a provider? That means everything. And so I thought it'd be helpful to kind of talk to your listeners, kind of about how that works.
So it sounds like a lot of value provided here and a lot of different things to consider. And I do feel like we've been able to touch on a lot, but just keeping an eye on the time here, are there any quick points that you think I've missed that you would like to still touch on?
No, I think we really covered it. I think it is becoming um, like a more mainstream um, idea with institutional investors. So the Fidelities of the world, and the T. Rowe Prices of the world. Number one. Number two, it's becoming much, much more palatable for the public companies who are considering it. And again, I would encourage public companies who are thinking about it, is I would encourage them to think about it as, like I said earlier, more of an investment than an expense. Because I think at the end of the day, it could add just really significant value, but you definitely need to be selective about how you're working with. I refer to it as kind of the wild, wild west before, because if you look at the traditional market, there's a lot of behemoth competitors. I mean, if like I cover T. Rowe Price, for example. They're one of my clients, and T. Rowe Price does a quarterly vote, and there's about 250 research providers on the quarterly vote. But when I'm going to the market as a CSR provider, there are so few firms that do it. There's no industry standards. There's no guidance. And so it's great to see NERI stepping up and number one, endorsing the idea, and number two, giving people guidelines about how to move in that direction if they ultimately decide, that's the way they want to go.
So, one last super quick thing before I let you go, because I do want to be conscious of time and I
Yeah,
definitely make us go over here.
yeah.
You've walked us a bit through where you are now, where you've been professionally, but if you take us back to the beginning, what was the first job as a kid that you ever had?
First job as I had a kid.
Hmm.
Oh my gosh, that is so funny. I was well, I'll give you two things. One, I was a busboy at a pancake house called Perkins. Um, and I actually got fired because I tried to organize the busboys because the way that it worked, all the waitresses sort of pooled the tips for the day, and then the busboys got a percentage of that. But nobody ever confirmed there was no independent validation of how much was in the original pool. So there was no, so I tried to organize the busboys to to hold the waitresses accountable for the tip pool. But then the other one was my dad. Thought it'd be fun to put us in. He was doing closeouts. It was like a crazy sort of business, but it's when big manufacturers would have discontinued items, or they would change the packaging, or they, um, for whatever reasons, maybe had like slight quality issues. They would sell those products in what's called the closeout market. And so for a summer, he had us calling manufacturers. There was a big register called the Thompson Register, and it was like this set of 20 binders. Each one of them had 400 pages in it. And my brothers and I were sitting there um, calling manufacturers randomly to see if they would have closeouts. And if they did, we asked them to send us a sample. And then we would go try to sell off the samples, and then order the goods after we had already sold them. And I had the greatest summer, and I was hugely successful. And I said, Dad, I don't want to go back to college. And he said, You're going back to college. I said, No, I want to. He said, The business isn't big enough for you. I mean, like, Dad, the business would be much bigger if I were here. He's like, You're going to college.
That is so honestly the dichotomy of those two things is so funny. And the fact that you lost the job at the Pancake House
I got
for
fired from
trying
Perkins.
to that is for trying to organize is so funny. And I am so glad that I asked you that because that might
Yeah,
have just made my day. That's incredible.
yeah, it's true. I still get grief from that from my parents. It's like
Oh,
funny.
I am sure you do. That is
Yeah.
incredible. Oh my goodness. Well, Norm, thank you again for making the time, and thank you all for listening. Again, that is Norm Siegal from Northcoast Research. This has been Small Cap Insights Podcast, powered by Darrow Associates, and I'm your host, Alex O'Toole. I'll see you all again next time.
All right. Thank you, Alex.
My pleasure.